We have some really important people, highly informed, that will be presenting, but for now you're stuck with me. And they have asked me to go over, if I could, talk a little bit about the second edition of the book that I wrote and was published some years ago called Buy and Hold is Dead Again. This is the new cover. It's Buy and Hold is Still Dead Again. I want you to know that the title Still Dead refers to what has gone on in the markets since the book was published, and I'm going to talk a little bit about that in just a second. But I can see now, I was just on the, I don't know if anybody here comes from a Baltimore orientation. Dan Rodericks is a pretty well-known columnist in Baltimore. He does a podcast that I just recorded, and he introduced the book about 5 different times as Buy and Hold is Dead Again. And so the Still Dead Again is now referring to the fact that nobody's going to get the right name. So we'll try and work with it. I do want you to know the publisher of the book was not overly pleased with sales of this book. They were looking for kind of, I don't know whether it was a, what kind of prizes they thought they'd win. Certainly bestseller status, we didn't get it. They asked us, we've been in some very strong negotiations. They want us to change the name. This was the name they had come up with, 50 Shades of Markets. They thought if we kind of sexed up the title a little bit, maybe we could do sales. And I'm not overly sure. It didn't fly here in the leadership team, so we went with Buy and Hold is Still Dead Again. The new book has an updated preface, and I'm going to talk to you a little bit about what I wrote there. There's a new chapter. It's called Portfolio Strategy in a Post-Lehman World. The book was actually written before Lehman went bankrupt, and so it's been an interesting time, obviously, in the markets. There's a new list of tables and charts in the book, and we were asked many times to include an index, so that's in there. So there's a bunch of new stuff in this second edition. Now, I thought I would give you this chart to give you some idea of what's going on. Since I published a book called Buy and Hold is Dead Again, you could see that the markets have gone straight vertical, and the investment team came to me and they asked if I would publish a second edition in hopes that it would go vertical for the next 5 years. And we'll see if there's any correlation there. But actually, I do talk, and I wrote about in the first book, the bull market that was to come. And I mentioned in the book that perhaps the reasons for the next bull market wouldn't have been what traditional academic research would have suggested. So you can see where the book was published and where the second edition is. So I thought I'd share a story with you that gave me a little bit of an insight into the media. So who here has ever heard of the Motley Fool? Anybody here, right? So very, very well known. When the book was published, we had a very, very nice publication party at Congressional Country Club. Anybody was there? Some of you may have been there, right? It was a very nice event. And the Motley Fool called. They wanted to interview me about the book. They showed up as, the first clue was they were all dressed in jeans and t-shirts at Congressional Country Club. So there was a big argument. We were trying very hard not to have them tossed out of the club. The people at Congressional were very angry with the people from the Motley Fool. But anyway, after the event, they interviewed me, and we went through all of the really theoretical and academic underpinnings of the first part of the book, which talks about modern portfolio theory and means variance optimization, and why technically we didn't believe in that anymore and we were moving forward. Great interview. And when the interview actually came out, the headline was, Ken Solo disagrees with Warren Buffett. and because Warren Buffett, as you may know, believes that you should buy stocks or companies at a big discount to their fair value with a margin of safety, and then you should hold them as long as it takes for the market to catch up, which has nothing whatsoever to do with the kind of buy and hold investing we talk about in the book. And in fact, he is iconic for us in many ways as value investors. So that was kind of a little bit of a clue that maybe we missed a little bit. Now, in the book, I forecasted a bull market, and I did, and I said in there that what would inevitably happen was that the market fundamentals would become very, very positive. Stocks would get cheap, and it's like happens in every other cycle. From there, we would launch a new bull market. And my forecast was abysmally incorrect, because this particular bull market, at least in my opinion, has been launched on the back of some absolutely unprecedented intervention by central banks and liquidity events and all kinds of stuff nobody could have possibly imagined pre-Lehman. And so I kind of kid myself a little bit in the preface and talk about how my forecast probably wasn't very good. Another thing that's going on in the industry I'd like to share with you is the industry. You know, 2 years ago at this meeting, I spoke to our audience, our clients, about being focused on complete market cycles and evaluating investment performance, and how critically important it was to have a longer-term view of evaluating performance and evaluating how you're doing in your financial plan. And the industry has gone exactly opposite. They're doing it now exactly wrong. Most of the discussions about active management are literally in the lens of how did you do in the from 2007 to 2009, a market decline. They look at every peak to trough decline. That's how risk is defined. And if you were in the market and in any way, you would be considered a failure in terms of managing risk, all of which we believe is just as wrong as could possibly be to do that. And it leads to a lot of mischief in the market. One of the things it does is it has led to some of the most horrifying investment products come out in the market over the last 5 or 6 years that I've ever seen. These products, just to give you a few examples, would define risk as, let's say, junk bonds. You would invest 100% of your money in junk bonds, and when their model doesn't like junk bonds, you go to cash, and you flip back and forth between junk bonds and cash. There are other models that do the same with emerging markets. You put 100% of your money in emerging markets, and then when the model doesn't like it, it goes to cash. Carl will be talking about emerging markets. That particular product is not around anymore. Just a whole lot of mischief that hopefully in this room, with the guidance of your wealth managers and the team up here, we've helped you avoid some of that. In the book, there is a chapter in the book called What's Wrong with Quant? And when I wrote that chapter, I was referring to quant, the original quant model, as being modern portfolio theory. Nobel Prize winning theory going all the way back to the 1950s that has guided our industry for a long time, and just taking on the theoretical problems with quantitative analysis and begging investors to consider some type of subjective qualitative analysis of what we do. And at the time, Rick said to me, Ken, that's not really what quant means out in the world. Quant is a whole different kind of a thought process. If you do this, you're going to confuse people. And I said, Rick, you don't know what you're talking about. It'll be just fine. But now that we've introduced 2 different products with quant pieces to it, I thought it would be good to just clarify here. There's nothing wrong with quant, folks. Quant it's all good. It's just using modern portfolio theory without any idea of a subjective piece to it. Bugged me at the time, and I wrote that chapter. So why should you read Ken's new book? It gives you a good review of the theoretical and academic reasons to actively manage money, which it does. It explains in detail how we actively manage your money, and if you can wade through all 16 chapters, you will be highly educated as to what we are doing for you. But what we've learned is it is actually a very good, powerful, non-prescription sleep aid. If you keep the book by your bedside, that usually takes, we understand, no more than 3 pages, and you'll have a sound sleep. So with that, I think it's time for me to get us on to, I think, the important part of our presentation this morning. Let me introduce Rick Vollaro, our Chief Investment Officer, and he's going to get us started on a great program of learning about the markets.
Okay, hopefully that's not too loud, decent. Thanks again for coming out, everyone, today to Pinnacle's brand of March Madness. It's nice to see some old faces and some new faces as well. And you know, in a minute here, what we're going to do is we're going to march up, and all the guys are going to come through and talk about a maze of technical analysis and valuations and business cycles and monetary analysis. And Sauro Locatelli is going to tell you that he's smarter than the rest of us. So I'll just put that in advance. He's going to tell you that. And he's going to sound it because he's Italian too. He comes out good, so he's going to sound it. But before we get started here, I really want to just pull things back for just a second and talk about context in terms of what is the mission of this investment team, really, at Pinnacle Advisory Group. And we have to remember that Pinnacle as a group is not just an investment firm, right? We're a wealth manager. And hopefully what we're doing is giving you all as clients the best of both worlds, right? You get comprehensive financial planning from a group of experts in the back of the room right now that you know, as well as risk-managed tactical portfolios. And that's where we come in as an investment team. And frankly, if we're doing our job right, what we're really trying to do for you is compound your wealth over time in excess of inflation. And during bull markets. So if we look at this chart right here, you can see this is the S&P 500, right, over many different market cycles. So you see 3 green arrows there representing 3 bull markets. And you see 3 red arrows as well, because every once in a while the market has to pull back and refresh, right? Those are cyclical bear markets. At least 2 of them are defined that way. One of them we think might be shortly defined again that way. But if we do our job right for you, what we're looking to do is keep you invested as those green arrows are going up, right? That's when you should be looking to compound your wealth over time. And then when we hit a stage where we think the red arrow is there, that's our time to pull back a little. Take a little risk out of the portfolio, allow you to lose less, so that when we get to the next green arrow, hopefully we're back to compounding your money again. Now, I think we live in interesting times for sure, and if you rewind the tape probably 1 year from today, or roughly the last time we had this meeting, if you remember the overall theme of that presentation, it was riding an aging bull market, right? So we knew that we were in the midst of that last green arrow in this chart, riding up 6 years, 200+% on the S&P 500. That's a really good move. That's the kind of thing you want to stay in, right? But during the middle of last year is when we first hit a couple powerful signals in the market. We thought, what, maybe that green arrow is beginning to adjust now. Maybe we're getting a transition from a bull market towards a bear market. And that's when we started to make some moves and adjust the portfolios. Now, it's kind of interesting that just this last week, right, was March 9th. And all throughout the media, I think you were hearing, hey, it's the 7th anniversary of the bull market, right? That was like a big push, if you listen to CNBC or Bloomberg, that type of thing. And it's true that if you look at a peak-to-trough decline in something like the S&P or the Dow, these are large cap indices in the U.S., you've only had about a 13 or 14% decline that the market went through. That really wouldn't register as a bear market yet. But we think that's kind of a shallow way to look at the markets. In fact, it's impossible to see, I know, and probably on this report card that we put up here for you, but we have 21 different markets globally on this report card. Right? We've got everything from U.S. markets to developed international markets to emerging markets. The average decline really throughout the cycle for the global markets are about 25% on that chart. And there's really only 3 markets that didn't go down 20%. So we would contend that the global markets have been riding through a cyclical bear market already. The real question is obviously the last couple of weeks here, 2 to 3 weeks, have been really robust, particularly in the U.S. markets, right? We're pushing up against the old highs. So, could it be that we're already through a cyclical bear market and getting ready for the green arrow to push up again to a new cyclical bull? It could be. It's one way to look at it. On the other hand, it could be that this is just halftime. I mean, cyclical bear markets are notorious for having very vicious, quick rallies that draw people back in. And so, that really is the question for us, for the board here, to decide right now. Is the cyclical bear market that we've seen over, or should we continue to be defensive like we've been here going forward for you on the precipice that, we need to be defensive here. We might still be in the midst of a cyclical bear market. So with that, I want to transition into some of the building blocks that we have, to determine, whether you're a cyclical bull or a bear and how to allocate the portfolio. You have to have a view, right? How do you come to that view? Well, here at Pinnacle, we come to that view with a multidisciplinary approach. In other words, we don't hang our hat on any one discipline. A lot of firms might look at valuation, or they might look at technical analysis. They might look at just the business cycle. That's what they do. We think you need to look at all of these things together. So what you're looking at right now really are the building blocks, we think, or the foundation for how we come to a view, and that view ends up setting the allocation for the portfolio. So if we do two things right today, hopefully you'll walk out of here knowing what our view is and being very clear upon what is the view, and probably more importantly, you'll have some insight into how we get to that view, right? What is in the mindset of Pinnacle as they're going through and setting allocation. So let me start with the business cycle and the monetary cycle, and then my colleagues will start to march up here and take some more of these building blocks along with me. So let's get going with the business cycle here in the U.S. Very important, obviously, is to know whether or not you're in an expansion, or you're headed for a recession, or you're in a late expansion, early expansion, because all of those things have big implications for how you want to set your allocation, what sectors you want to buy. And I think today here, as we talk about the U.S. business cycle, there's clearly a dichotomy between some good news and some bad news out there. And I want to start with the good news, because there certainly is some good news. I think one of the best things that we can hang our hat on right now in terms of the U.S. economy is that the backdrop for the U.S. consumer seems to be pretty strong. I mean, I think we can all agree, as we've been pulling up to the pump over the last couple of months and seeing sub $2 gasoline, that's a pretty good thing, right, for the U.S. consumer. And it's not just gasoline. I mean, clearly the inflationary environment here, gas and oil, certainly mortgage rates being low, these things are very supportive for the consumer. And it's not like the consumer really overspent during this past cycle either. I think the consumer could probably, it's probably been pretty frugal, really, during this whole expansion cycle. There's a savings rate now of about 5.5%. That's up substantially from where we were just a number of years ago. So, all in all, I think, when the consumer makes up 68% still of the U.S. economy, you have to like the backdrop structurally for the U.S. consumer right here. So that is a positive right now that we're watching structurally within the U.S. Another positive would be the jobs markets that have had a lot of resiliency to them lately. Now, I wouldn't sit up here and point to something like the unemployment rate. Yeah, it's nice that it's 4.9%, but that indicator is typically very lagging, meaning that it doesn't tell you anything about what's going to happen in the future. It's all in the past, and oftentimes it looks the best it's going to look right at the tail end of the cycle before things turn. So that's not a great one, but a much better leading indicator within the jobs market is the unemployment insurance claims. We follow those pretty closely. That's what this chart is looking at. It's a very long-term chart. And we've been encouraged lately that this particular indicator continues to sit at sub 300,000 levels. Just basically meaning that there's not been a lot of pressure on to fire people. There's not a lot of people lining up for that claim to go collect unemployment insurance. So that's an encouraging sign that the jobs markets continue to have some strength in them. The third positive I'm going to talk about is probably a little bit more nuanced. That gets to currency in the U.S. dollar. Now, without getting into too much of the complexity of how currencies work, I think probably most of us have heard over the last year or so a lot of complaints about the dollar, and it's really not so complicated. As our dollar rose over the last year and a half, at a very rapid pace, and that's what this chart is showing you. It's showing you a year-over-year rate of change in the U.S. dollar. What that did is it put pressure on a couple things. Number one, it put pressure on trade, which makes a lot of sense, right? Because if we're exporting goods in our dollars and it's getting stronger, then countries that are having some problems, frankly, right now, outside our boundaries, all of a sudden they're faced with goods that are even more expensive. So that's a tough thing. It's tough on trade for us. It also really is a tough thing on multinational profits, where again, if you're a big company and you have operations overseas and you're selling goods, now you have to translate your income back into dollars from a different currency, and that hurts your profit equation as well. So that had been a very big headwind, I would say, over the last year and a half. It's nice to see that the rate of change in the dollar, in other words, the appreciation is really starting to slow. You can see on this chart, it was really peaking back in the last year in the first to second quarter. And since then, we've seen a really big deceleration in the speed of the dollar. So to the extent that this stays like this, and we don't see another surge in the dollar, that could be supportive of the U.S. economy from a trade perspective. So those are some of the good news. How about the bad news? Because I did say there was good news and there was bad news. And there's certainly things here that we're watching very closely. I would think there's a set of indicators that we're most concerned with right now, and they are the leading indicators, right? Because again, we want to look at indices in kinds of indicators that are not telling us what's happening today or what happened yesterday. We want to look at things that are going to tell us where the economy is going in the next quarter or two. And frankly, most of the leading indicators that we're watching are not projecting the economy to reaccelerate. Okay? I think the markets right now are guessing that the economy maybe looks okay and is going to start to reaccelerate, but we're not seeing in the lead indicators. This is just one that we watch. It's called the OECD US leading indicator. It's actually been down now for 17 consecutive months. And it doesn't show any sign here of troughing. So to us, that's not a particularly encouraging sign in terms of the U.S. economy. To us, it means likely we'll stay in this slow growth mode or perhaps even get slower. Another thing that's been somewhat of a warning signal, in my opinion, is just been watching corporate default risk beginning to rise. And one way that we monitor that is to watch high-yield bonds, right? Non-investment grade bonds. This up on the charts here, this is just one index that we watch. It actually is an exchange-traded fund. It's the JNK High-Yield Bond Index. We haven't owned this, just so you know, for years and years, which has been good news. But what you see here is a big depreciation that's been happening here over the last year, year and a half. In fact, this line has gotten really the lowest it's been since the great credit crisis that we had back in 08 and 09. And while I wouldn't argue that we're anywhere near that type of crisis overall, maybe in patches, right? The oil patch has had a lot of problems lately, for sure. There's certainly a lot of energy debt that's inside of this sort of an index. But I think the bigger message here is again, that when junk bond indexes start to turn down like this, what's actually happening is that the market is telling you that there's an implied default rate that's beginning to look like it's picking up in the economy. And that's not good news usually for the economy going forward. So we're going to continue to watch this. We're getting a bit of a bounce out of it now, which is good. Can it sustain or not? We don't know. But it's not one of the more encouraging things that we're watching. Lastly, earnings themselves in terms of corporate America haven't looked particularly good over the last couple of quarters. In fact, the chart that we're showing you is a little bit worrisome in terms of the profit equation and what corporate America is telling us about the state of the economy. What you have here is a year-over-year change in U.S. earnings. These are as reported earnings. They're GAAP, generally accepted accounting principles, and they have gone negative recently. So if you think about the stock market again, if you're looking for gains in the stock market, you either think that the earnings are going to grow, or that investors are going to pay more for those earnings in a multiple, right? Well, right now the earnings are not growing; they're actually contracting. And the last 3 times on this chart that happened, you actually were on the precipice or in recession. So the earnings were telling you something, corporate America is telling you something here, something that we're taking notice of, not particularly good. I'm going to switch gears here for one more minute and talk about U.S. monetary policy. Last year we had a buzzword for monetary policy, and that was normalization, right? There was an idea that the U.S. Fed wanted to take the U.S. rates on the short end from 0% policy, which again is a very unusual policy that we've had here for many years running, since 2009. And they wanted to start to cycle that up. Now, normally that's not a terrible thing as long as the economy is expanding. Factories are humming, capacity is getting tight, and a really good expansion, that would be no problem. The first 0.25% rate hike shouldn't matter at all. But we haven't been in exactly the most usual world. And frankly, by the time they raised rates last year, our economy was decelerating. Right? We went from a 4% GDP number in the third quarter, in the second quarter last year, to a 2% in the third quarter, to a 1% GDP growth rate in the fourth quarter. That's a deceleration in growth that's pretty clear. At the same time, manufacturing was having serious problems. There were pockets of manufacturing that we would say were in clear recession. So, very odd time for the Fed to decide that they wanted to raise rates. At this point, it just seems like they might be caught in a bit of a tough box right here, right? If the jobs numbers that I just talked about continue to go up, that only encourages the Fed to continue to raise rates right here. Raising rates again into an economy that's slow and perhaps will continue to slow, if the leading indicators are right, doesn't seem like a great idea. If the data goes the other way and falls off a cliff, you don't have many bullets here to defend, right? You've had a 1/4 point that you raised. Outside of that, you might have to go back to unconventional policy like quantitative easing again, maybe even negative interest rate policy, which is causing its own problems. I think Carl will get into that later. So the Fed's caught in a tough box, and I think the overriding message here is that when you think about it, for 6 straight years as the market went up, on that bull market chart we talked about, right? Very powerful bull market move, the Fed was a huge tailwind to risk assets. All of a sudden now, there's a lot of uncertainty with the Fed. They're beginning to raise rates. Why are they raising rates? Does it make any sense to raise rates into an economy that's slowing? A lot of questions. And to me, the uncertainty that we have here in the Fed really now takes that tailwind and turns it into a headwind. So that's enough for me now in terms of the U.S. cycle and the monetary cycle. For now, I think I'm going to turn this over to Carl Noble to talk a little bit about international cycle dynamics, and then I'll be back at the end to wrap things up. Thanks.
Thank you, Rick, and good morning. I'm going to be spending the next few minutes going through some of the evidence as it relates to international markets. And we'll start with the outlook for growth. We'll begin with developed economies first. So the good news is that developed economies overseas are growing at the moment. Europe is growing at about 1.5%, while Japan is a little lower than that and closer to 1%. So we have positive, but it's still pretty slow growth overall. One of the differences lately that we're starting to notice is a possible change in the sense that we're starting to notice a little bit of a loss of momentum in some of these economies. So last year, for instance, the economies were growing at pretty similar growth rates overall, but there was a little bit more of a noticeable upswing. Like they actually had some positive momentum in some of these recoveries overseas. But since then, we've actually seen these economies lose a little bit of that steam that they seem to have. So I have one example of that here on this slide. This is the Composite Purchasing Managers Index in Europe. This is just a broad representation of the economy that includes both manufacturing and service sectors. And you can see on the chart, which starts in 2013, that there was a pretty good upswing going on from 2013 into 2014. It did experience a little bit of a dip, but then recovered and actually made a new high in the middle of last summer. So things seem to be going pretty well as of the middle of last year. Since then, however, you can see that the line has kind of flattened out a little bit and started to pull back some. And while the pullback may not seem all that dramatic at the moment, I think our concern lies in the fact that, again, you're coming from a pretty low starting point in terms of rates of growth in these economies. So it really wouldn't take much at all to potentially cause these economies to roll over again. And so in our view, at the margin, the outlook for growth in developed economies has gotten a little worse over the last few months, largely because of a loss of momentum like what you see here. Next, we'll turn to emerging economies. And this is where we actually are more concerned about the outlook for growth. Emerging economies continue to weaken over the past year and a half, and this is being largely led by China still, which is in the middle of an ongoing slowdown that is impacting the rest of the world. So China had its slowest growth in 25 years last year. It was about 6.9% as far as the official GDP that was reported. And so close to 7% GDP growth might seem like it's actually really good, but I would point out a couple of things. Number one, GDP growth in China was actually a lot higher than that just a few years ago. So they've already been steadily declining from double-digit rates of growth to where they are now. And number two, there's actually a growing skepticism about the accuracy of the officially reported GDP number in China. And I have an example of that here on the slide that you're looking at right now, which is a coincident index put together by independent sources. So this consists of different economic indicators like industrial production, retail sales, corporate profits, income. So again, it covers a pretty wide swath of the economy in China. You can see not only has it fallen a lot over the last few years, but it's actually below where it was in 2009. So I don't know about you, but I find it kind of odd, or there seems to be a pretty big disconnect between, on one hand, officially reported growth as high as 7%, and on the other hand, private data showing that growth is actually below where it was in the middle of the global financial crisis. So we actually fall in the camp that we think growth in China is slower than advertised. We think the headwinds in China are pretty significant still as we head into 2016 here. And for that reason, we think that it presents a pretty big risk to actual outlook for growth for the overall global economy. Next, we'll turn to monetary policy. And Rick just touched on it for the U.S. And although the Fed is actually hiking rates now, and so they're backing away, or beginning to back away a little bit from providing easy policy here in the U.S. anyway, that's not the case outside of the U.S. In fact, global central banks are doing virtually everything they can still to counter the effects of this slow growth, low inflation environment that we've been in. One of the newer tools that they've actually been using is to introduce negative interest rates. And you can see on this chart here that most of Europe now has negative interest rates on the short end of the spectrum, and Japan does now too. So we've actually transitioned, hence the title of the slide, from ZIRP, zero interest rate policy, to NIRP, negative interest rate policy. Now, what are the implications of this? From the central banker's standpoint, this is really just an extension of what they've already been doing. What this actually does now is it imposes a slight penalty, mainly on banks, to try to further incentivize or encourage them to lend money out into the economy instead of having it just sit idle at the central bank. I mean, that sounds fine, but one of the big differences we're starting to notice now is how the market is reacting to this. So, over the past several years, whenever central banks did virtually anything, we typically saw a positive reaction in the markets where stocks were going up, and it seemed to really be benefiting the markets at the time. But lately, we've actually seen sort of a reversal of that. Markets have been reacting negatively across things like currencies, interest rates, and even stocks in some of these economies. So again, we think that the market is beginning to sort of begin to question whether policy may be starting to run into some potential limitations. What I mean by that is the further and further that they push and use these unconventional policy tools, it may be actually starting to do more harm than good overseas. And so for that reason, we think that the policy outlook globally, even though central banks are still very active, may be a little bit less supportive than it was previously. And I'll close here with touching on valuation overseas as well. And generally speaking, markets outside of the U.S. are cheaper than they are here in the U.S. And I'll jump right into the slide here to try to illustrate that. The top line that you're looking at is for the S&P 500, the blue line, which trades at about 16.5 times estimated earnings. These are price-to-earnings ratios that you look at. I should have pointed that out, sorry. The next line is, the red line is the EFA index of developed international markets, which trades at about 14.5 times earnings, so it's a little bit less in the U.S. And then the lower line, the green line, are the emerging markets, which trade at about 11.5 times earnings. So normally we would view this as pretty positively in terms of favoring international over U.S. because they're trading more cheaply, but we have a couple issues with this too at the moment. Number one is that oftentimes in markets, something is trading at a discount to something else for a reason. In this case, we think it has a lot to do with the fact that these economies are facing larger headwinds in the form of slower growth, larger exposure to the complete collapse in commodity prices that we've seen, and that sort of thing. And the second thing is that you can see on the chart that these have actually been undervalued relative to the U.S. for several years. So going back to 2012, 2013, you can see that PE ratios have consistently been below the U.S. However, over this whole time, these markets have continued to underperform. The U.S. has actually been a big leader throughout this whole cycle. So we are intrigued by the idea of better value, but at some point as we move forward, we think that it could provide an opportunity to perhaps increase exposure globally in the portfolios. We just don't think that time is now just yet, just based on value. We'd actually like to see better value paired with other improvements such as better growth and that sort of thing. So to quickly summarize, we think that the outlook for growth overseas has gotten a little bit worse. We think that policy might be a little bit less supportive than it was. And valuation, yes, is cheaper, but that may not matter in the short term without other catalysts to help the markets reward that. And with that, I'm going to turn things over to Sean Dillon.
Thanks, Ken. Good morning again, everybody. As you heard from Rick, our bigger mission here is to catch the bigger moves in the equity markets around the world. So as a technical analyst here, it's my responsibility to review the hundreds of different technical tools at our disposal to distinguish or determine if the larger move is up or the larger move is down. Now, since 2009, we've been in a move up, or what we call a primary uptrend. However, if you were here last year, the bulk of my presentation focused on the indicators that we watch signaling underlying deterioration in the uptrend. We were starting to see cracks emerge. The only thing that we did see was price confirmation. But we actually think we just got that earlier this year. The best way to show that is by using a trending tool. This is the S&P 500 in blue and a very simple 150-day moving average, trying to get a sense of the trend of the market. So you can see, going back to 2012 on this chart, that the trending tool and price were both in uptrends. They were both moving higher. Not only that, but the 150-day moving average was acting as support for the market, which means that as prices move higher, people who want to get in generally want to wait for pullbacks or corrections to get in. And what better time than when the price is at its average over the last 150 days. So it acts as support and makes the market move higher when these new buyers come in. But in the middle of last year, we saw a very different picture emerge. The price of the S&P 500 had a severe correction in August. It went well below the 150-day moving average. Not only that, but the average itself started to flatten out and has now even started turning down. So we went from an uptrend in the indicator to a downtrend in the indicator. And instead of acting as support for the market, it's now acting as resistance. People who have large positions that want to get out weren't able to do so because of the quick move down in August when prices rise. What better time to get out than the 150-day average? So that's what we're seeing here. We have a very different character change in the market. And you'll notice once again the S&P 500 is back to this 150-day moving average. So we'll see what happens from here. But this is also, this is just the S&P 500. We're seeing this on a global scale as well. So let's take a look at some different indexes around the world. This is the Nikkei in Japan. Very same picture that you had in the U.S. market. You had an uptrending indicator, uptrending price. The indicator was supporting price until the middle of last year. A break of the trend, and now it's turned into resistance. Same with European markets. This is a look at Europe. Uptrend, support. Now we have a break of trend, and the trend is now resisting price. Emerging markets, slightly different picture. They've had a tough time over the last few years. So going back to 2012 to the middle of last year, they weren't even in an uptrend when everybody else was. They were in a flat market, just moving sideways. But they also had in the middle of last year pretty significant price declines and what we think is now a pretty established downtrend. And not surprisingly, when you group them all together, this is the MSCI World Index. Very same picture, uptrend that has turned into a downtrend. Prices being resisted here. Now you also heard that Rick put up a slide where we saw major declines around the world, not only here, but bear markets globally, even worse in a lot of emerging economies. Unfortunately, we don't think that's the end of the selling according to our technical work. And the reason for that is that a lot of our indicators are still pointing to downside. This is a long-term momentum indicator. Momentum tries to measure how fast or slow prices are rising. And again, just like throwing a ball up in the air, momentum tends to come down well in advance of the ball falling. Very same concept with price. So it's really important. It gives you an early indication of weakness. I showed this chart last year for the main reason that we saw the momentum indicator starting to turn down. And not only that, it gave what is a sell signal, which is basically the blue line moving below the orange line in the bottom panel. And historically, these sell signals have been very powerful in terms of their forecasting bear markets, so we took it pretty seriously. Now, if we're looking at this indicator today, three things point to the downside still, according to it, and that would be that we're still on a sell signal. It's still below its signal line, the orange line. Not only that, the line is still moving downwards. There's still strong momentum to the downside. And additionally, the indicator typically goes below zero if we're in primary downtrends. And right now, we're still well above zero. It has to get below zero and become what we call oversold in order to alleviate a lot of the overbought conditions that were present after 6 years of bull market. Not only that, but our breadth studies are also showing weakness right now and pointing to lower prices. Breadth measures participation within a stock market, and this is one way of doing so. This is stocks that are down 20% or more from their 52-week highs, or stocks that are in bear markets, basically. And I have on here in blue the small cap index, and then in green the large cap index. And what you want to see in breadth studies, if you're in an uptrend, you want to see a lot of stocks participating. But in downtrends, you don't want to see that, because that just gives further evidence that the downtrend is pretty strong. Unfortunately, that's what we're seeing right now, is that the downtrend is still pretty strong. We'll just focus on the small cap index in blue. As of July high, 22% of small caps were in bear markets. Moving into the September low, what is that, 60-some, I think, percent of somewhere around there. Small caps were in bear markets. And then in the February bottom, 77% of stocks were in bear markets. So you can see the progression here that every single new low is accompanied by more and more stocks in bear markets. It's just saying that the trend is still very strong to the downside. What we'd like to see is less and less stocks in bear markets. That would give us a lot more confidence that we've seen the ultimate bottom. Unfortunately, right now we haven't. The last thing I'm going to point to is an intermarket study, just relating how different markets react with each other. This is one of the more interesting relationships that has developed over the last year. Typically, oil markets and the S&P 500 are not correlated, but they have been over the last year due to some of the reasons that were brought up earlier, that when oil is this low and falling, credit risks rise, companies get questioned whether or not they're going to be staying in business or not. So the S&P 500 tends to fall when oil prices fall. Oil prices are in orange and the S&P 500 is in blue. So you can see pretty strong correlation when oil moves lower, so does S&P. Going to the current period right now, we've had a pretty strong rally. Oil has gone from 27 up to 37 on West Texas prices, and the S&P 500 has followed higher naturally, if this relationship means anything. So our outlook for oil is very important right now, and being a commodity analyst, I'm going to jump over on the fundamental side of crude real quick, or crude oil, tell you why we think that oil prices are still going to remain pressured over the next near term, next few months, what have you. And that's because the fundamental picture is not supporting this price rise that we've had. There's still a huge supply-demand imbalance inside of the oil markets, in our opinion. Supply is coming down on the U.S. side in terms of production. A lot of the shale operators are starting to produce less, but the imports are rising from OPEC, kind of negating a lot of the effect that we've seen on that decline. Additionally, demand is also falling. We have really big issues in terms of inventory and storage capacity, so that the refiners are starting to demand less until those inventory levels are brought down. And then with storage capacity running about 90%, most specifically at Cushing, which is a major West Texas hub, they can no longer demand product with storage levels where they are, so their demand is going to be lessening. So supply is coming down, demand is also starting to weaken, and that's keeping our supply-demand imbalance pretty sticky right now. And until we get a better balanced market, we're not going to see any sustainable price increases. So if this relationship holds up, and if crude oil prices start to lower back down into, perhaps even the 20s that we saw just a few weeks ago, that would suggest that the S&P 500 will follow lower. So as a quick recap, from a technical perspective, we still think that we're going to be seeing lower prices ahead. The primary trend, in our opinion, is down. A lot of the indicators that we watch right now are also supporting this conclusion. So, sorry to be bring a pair of bad news here, but it is what it is. So with that, I'm going to hand off to Sauro.
Thank you, Sean. So I guess being Italian means that I like soccer, right? It's funny, but it's actually true. So thank you for sticking around. Over the next 10 minutes or so, we'll review two models that we use at Pinnacle that focus on the S&P 500. The first one is the valuation model for the S&P 500, and the second one will be what we call the short-term model for the S&P 500. We'll start with the valuation model, which is essentially a gauge of how cheap or expensive the S&P 500 is at any point in time. The model is a composite of 19 different valuation measures. And just to give you an idea, it includes some of the more traditional valuation measures, such as price to earnings, price to cash flow. We all know those. But it also includes some more, I would say, exotic valuation measures, such as Tobin skew, the price of the S&P 500 measured in gold, and the percentage of household financial assets that are invested in stocks at any point in time. So this is just naming a few just to give you an idea. We're going to be looking at a chart that goes back to 1946, so we have 70 years of history. And on this chart, the red line represents the valuation model, which works on a scale that ranges from 0 to 10, where 0 is the most overvalued reading that we can get from the model, and 10 is the most undervalued that the model can get. And you can see the scale on the left side of the chart. We're also going to add one more line to the chart in blue. And the blue line here measures the actual return of the S&P 500 over a period of 10 years on a forward-looking basis. So essentially each point on the blue line is measuring the actual return of the S&P 500 over the following 10 years, which is why the line stops in March, exactly March of 2006. That's the return that you would have achieved if you invested in the S&P 500 at that time and you sold your investment today. So, and those returns, by the way, are shown on the scale on the right side. So it's pretty easy to see how the two lines tend to move together over time. In technical terms, we can say that they're highly correlated. And that means that where valuation is at a given point in time has a big impact on returns over the following 10 years. It also means that we can take a look at what the valuation model is saying right now and use that information to make a projection for the type of return that we can expect from the S&P 500 over the next 10 years. So, as of right now, the latest update from the model as of the end of last month gave us a rating of 1.9 out of 10, which falls into the range that we call very overvalued. It goes from 0 to 2. And based on that 1.9, the projected return for the 10 years, for the next 10 years, is just 3.5% on an annualized basis, which is clearly well below the long-term average return of the S&P 500. Now that may come as a surprise since we all know we've been talking about the fact that the S&P 500 has been going through a correction. The top to bottom decline was about 14%. And if you follow CNBC or Bloomberg TV or any other financial news outlet, you may have heard people talk about the fact that the S&P 500 has fallen, it's cheaper now, it's time to buy. Well, clearly our analysis does not support that view. We did see a little bit of an improvement in the valuation model. You can see it from the red line hooking up more recently in the orange circle. But we're still in the very overvalued zone. So, it would actually take a much larger decline in the S&P 500 from here to get the valuation model to move to a level that we consider to be neutral, let alone undervalued. So for now, our view is that the S&P 500 is still overvalued, so that is a bearish message as far as valuation goes. Now let's switch gears and move to the other model that we're going to discuss today, which is the Pinnacle S&P 500 short-term model. Now, as opposed to the valuation model that we just looked at, which we can use to make projection for returns over the very long term, this model is designed to make projections over a much shorter time frame. Specifically, we're targeting a 6-month time frame. And in order to do that, the model doesn't rely on any valuation measures at all, because those typically don't really work over such a short time frame. But instead, we use technical and macroeconomic indicators that we have found to lead the stock market over a period of about 6 months. So again, we're going to look at a chart, and the red line on this chart represents, again, the score of the model, which works on a scale between 0 and 10, again, where 0 is the most bearish that we can get, and 10 is the most bullish message that we can get. And this scale is once again shown on the left side. So the first half of the red line that you're seeing right now starts in January of 2014 and ends in March of 2015. That was the date of our Inside the Investment Committee meeting last year. And what we at the time, what we saw from this chart was that the model had been moving around between the mildly bullish and very bullish brackets for a while, and then declined and fell down into the mildly bearish range, and then settled into the neutral range. So at the time, we talked about the fact that the model was neutral. This is what happened after the meeting and through last week. The model continued pretty much to bounce around between neutral and mildly bearish, and actually ended last week into right in the middle of the mildly bearish range. Now that's what the model did. Now let's take a look at what the S&P 500 did over the same time frame. The blue line here represents the return of the S&P 500 over a 6-month time frame on a forward-looking basis again. So each point on the blue line gives you the actual return of the S&P 500 over the following 6 months. And the first section of the blue line that you're seeing right now is basically what we already knew last year at our meeting. The blue line ends 6 months prior to ITIC 2015. And what we were seeing at the time was that the S&P 500 was actually going pretty strong. Returns were ranging between 5 and 10% on a 6-month basis, which was more or less consistent with what the model had been forecasting. But like I said, we already knew that last year. Let's see what happened after our meeting. And this is what happened. So pretty much right on cue, as the model had predicted, the S&P 500 returns cooled off and had been staying in a range that goes from 0 to -5%, so much weaker, and like I said, in line with what the model was forecasting. Now, the model is essentially forecasting more of the same at the moment. The latest update was a 2.9 out of 10, which falls into the mildly bearish range and corresponds to a projected return over the next 6 months of -5.4%. So that is also a fairly bearish message coming from this model. Now, in addition to our own short-term model that we created internally and we run internally, we also track a number of external models that focus on the short term. These are produced and updated by some of our independent research providers. And the table that you're seeing is essentially a very simplified version of the scorecard that we use to keep track of what the different models are saying and to come up with an overall assessment. So as of our meeting last year, as we saw, our model was neutral. That's the one at the top of the table. But actually, pretty much all the other models that we follow were bullish, or lining up perfectly bullish. So at this point, you might be thinking, "Wow, your model was right and everybody else was wrong. Like, you guys are amazing." And, well, I agree. So actually, let's look at what happened this year. So we said that our model switched to mildly bearish. That's what it is right now. When you look at the other models, they're not nearly as uniformly bullish as they were last year. They're a lot more mixed. We have 2 bullish, 1 neutral, 1 bearish. So, even though these external models pretty much blew it last year, we still think they are fairly decent models that we need to put some weight on. So as a result, our overall assessment at this time is neutral. So just to recap, we said that the message from valuation is bearish. The short-term models are giving us a neutral message. Now keep in mind, these are only 2 pieces of our investment process that we need to use in conjunction with everything else in order to form our view and determine how the portfolios should be allocated. And this is what Rick is going to talk to you about next. Thank you very much.
I tell you, that accent sounded good or what? In fact, I'm thinking about just moving my lips and having Sauro talk for me. Short, right? All right, so wrap up time here. This is only going to take 3 or 4 minutes, but I think it's important because everything you saw, as we said in the beginning of this presentation, were building blocks. They help form the view, which we then use to allocate in the portfolio. So how do we bring this all together now and get it back to an allocation in the portfolio? Well, basically, we put together an evidence report card. And we like to do this every month when we come to the wealth managers and apprise them. And essentially, it just takes every area and gives it the rating. And then we go through a weighted the evidence approach again to determine how we're going to asset allocate within the portfolio. So, again, if I don't have last year's report card, but I can tell you if we did, just from a color perspective, as you look at the ratings that we have for the areas, there was a lot more green and yellow, bullish and neutral, and a lot less red, which I think is probably apparent from some of the presentations that we've had here, giving the building blocks and the views that you've heard sort of individually. So At the moment, the evidence in our opinion would still have us in underweight territory when it comes to risk assets, right? And we're going through a lot of detail here today, and there's always a lot of noise in the markets. It can get very confusing, but I think if you want to look at things from a very, very high level and just simplify things, I think the combination of very high valuation that Sauro pointed out and technical conditions of the market that we think are still broken, just the two of those things together, the technicals are the catalyst, right? Those demand risk management. So that's where we are at this time in terms of risk management mode. Now, how much we manage in terms of risk is always sort of a sliding scale and a moving target. At the moment, we position portfolios to have about 70% of volatility. In our prime models, where most people are, again, most of you are in the dynamic market growth and dynamic conservative or aggressive, these models, again, typically to give you kind of a baseline, we could probably go as low as about 50% volatility if we wanted to. So we're kind of in the middle zone between being neutral and max defensive here in the portfolio. Now, some might ask with our view, well, why don't you get max defensive right here? Well, we've done a lot of studies. And I think one of the things that we're continuing to hang on here is that we're still not calling for a U.S. recession. So when you go all the way back, rewind to the U.S. business cycle I talked about, there are still some positives that are keeping us kind of in the game here. And what we found that if you don't have a U.S. recession, typically even bear markets that occur, they're usually less in terms of their length and their magnitude. However, for some reason we were to tip and call a recession at some point, and it could happen, we're not there yet, that's where we might take ourselves all the way down to say a 50% max defensive position, because usually those bear markets get much more drawn out, much more messy, and the damage is worse. So we're kind of sitting right in the middle of the scale here where we feel like we've pulled a good amount of volatility off, but we're trying not to overdo it, the zone where we think, we're probably due for a shallow type of bear market, we'll call it that. Now, how do we get that 70% volatility? What do we do in the portfolio? We'll just simplify again. I mean, there's really two ways that we play in the game. One of them is simple allocation moves, right? Let's just cut the amount of equities we have and put some money into fixed income. So right now we've been building different parts of fixed income. And frankly, right now we have a lot of cash. And we've had some questions about cash, and we'll all sit here and admit cash is not the best yielding asset that's out there right now, right? But what it does have is that it's got liquidity and stability, and it allows us to very efficiently play the game defensively and be able to take that cash at some point, reutilize it, just rip it off as dry powder and buy when we think it's time to buy. So we think there's a lot of positive attributes to just simply keeping it pretty plain here in vanilla. And frankly, this gets to some learning curve too. I mean, in prior cycles, when you get to a down cycle, there's all sorts of exotic instruments out there that people will offer you up that are supposed to be great bear market instruments. But what we've watched in many cycles is that oftentimes when you need those instruments to work, they don't. They sound great in theory and they don't work well in practice. So that's why we're just kind of keeping it simple, stupid from an allocation perspective. The money's going to fixed income and cash. The other part of this is a rotation game. And again, I'll simplify. So for instance, in the U.S. equity markets, there's 10 sectors. And that breaks into about 6 of them that are typically pretty cyclical, and 4 of them that are typically pretty defensive, right? So cyclicals are things like financials and technology, materials, energy, industrials, discretionary stocks. It's pretty simple. It's a time to underweight most of those cyclicals in the portfolio. That doesn't mean own none of them, but underweight them to the benchmark for sure. At the same time, we're overweighting the things that are very plain and vanilla and throw off high dividends, right? And are much less cyclical. Things like utilities in the portfolio, staples in the portfolio right now, telecom services, those are the things that we're going to own. So, not the most complicated game when you make it down. The view is dictating what we're doing in terms of volatility, and then we're using these different tools to get to the volatility target that we think is right. All right, the last thing I want to get to is some silver linings here, because obviously this was not the most upbeat take that we've had in 14 years of doing this. And frankly, again, it's markets trend up more than they trend down. But every once in a while they have to refresh, and I think it's important to look at a bear market from your particular circumstance in the right context. I mean, a bear market is not really a terrible thing, especially for you all out there. You're trying to build your wealth, right? So if the markets just keep going up and up and up and get more expensive, that's not the best thing. You don't want to be buying markets that are higher and higher and probably getting more and more risk into what you're buying. Every once in a while things have to pull back, right? They have to get a little bit cheaper here. The upside of what's happening, in our opinion, is that some of that overvaluation that Sauro talked about should back itself off. So swollen valuation should come back to much more reasonable levels. Whether or not we really get cheap during this cycle, I have no idea. We got a long way to go. But even if we just return to sort of more normalcy from a valuation perspective, that would be good. It would give us a margin of safety in what we're buying. That's a really good thing. And ultimately, I think the way we're approaching this is that, look, nobody's here monstrously bearish. We're looking for a pullback to refresh valuations. And the way we should probably view this is sort of like a sale, I mean, nobody goes to the store, to Nordstrom, whatever else, hoping that, the coat they want to buy is more expensive, right, than it was yesterday. Everyone would rather go in there and see the sale on that same coat and buy it. Well, it's really no different with good companies. It's good assets. So you'd rather pick them up at a discounted price if you can get them. So that's kind of what we're focusing on here is, take some of the risk out of this thing, lose a little less, just like we said, was a bigger part of our mission, and then look for the point to buy in at cheaper levels to help build your wealth over time. So let me end it right there, and I think we're going to get into a little bit of a panel here, and then some of the questions from the audience.
Let me start us off, Rick, with a question for you. We know that our positioning in the portfolios is really based on a level of conviction, and I was counting the term bear market was used 3,412 times this morning. So I'm asking you to tell me that you're wrong now. Please do it. What is your level of conviction about this forecast?
Ken, I'm wrong. No, I mean, look, we've had a pretty high level of conviction since about the middle of last year that the market's going to transition to our bear environment. And I still think we have a pretty good level of conviction right here. Obviously, when you get to 3 or 4 weeks where the market, has come up like it has, it certainly tests your conviction levels, and it's testing and challenging our view, which I think is very good and it's very healthy. But again, what really dictates what we're doing is exactly what you saw. It's those evidence buckets that you looked at. If it's truly transitioning back to a bull market environment, the evidence categories will begin to transition one by one. We'll get a chance to get back in. And remember, looking at that first chart, typical bull markets aren't a week, a month, 10%. These are usually a couple of year events, go up 70 to 100%. There's still plenty of time to get into a bull market if you think this is truly a bull market reasserting itself. On the other hand, if we're right, it's probably much better that we're playing this game defensively right now. So we still have enough conviction here that we think that we should play the game defensively given the evidence that we have. But we won't be dogmatic either. I mean, if the evidence changes, we're going to have to change with it. That's all there is to it. And if it does, that's good news, right? Because we're probably starting to transition back up, and that could be building a lot of wealth for a few years' time. So conviction is there for now, but we won't be dogmatic in that view.
Thanks, Rick. The next question is for you, Sean. I made a note. I believe your comment was, "It is what it is," which I've made a note. We'll be studying that in the world of economics shortly. No, I was actually asked a couple times, actually before the meeting, a couple of our clients came up to me. They noticed we had bought some gold in the portfolios recently, and we've all heard your views here about commodities. How can we be bearish on commodities and getting long gold? Maybe you can help us with that.
I think there's 7 trillion reasons why. That's the amount of assets that are negative yielding right now, for one simple, quick answer. But we still think we're in a secular bear market for commodities. Typically, commodities and equities run differently than each other. And we think 2011 put a major topping for most commodities around the world. However, recently, with a lot of the unconventional policy tools that central banks are unleashing around the world, and then also some other fundamental positives. After a 4.5, 5-year bear market in commodities, we think the value has finally returned if you can actually value commodities. There's still some imbalances left. We don't think perhaps maybe the final bottom is in, but we're getting a lot closer than we were just a few years ago. And gold specifically has a lot of other fundamentals going forward with real rates starting to come back down over the next few years, and I'm sorry, over the last few years. And then also it acts as a pretty good defense when we're in bear markets or periods of crisis. So it's what we like to call part of our, what is it, Rick? The portfolio?
The portfolio protector.
The portfolio protector. So
Treasury bonds, the U.S. dollar, and gold.
So with our view, it makes a lot of sense to have gold in our portfolio and to perhaps start seeing after this downturn is done, a short cyclical upswing in commodities before the secular bear reinserts itself.
Thanks. Portfolio Protector is a new Marvel movie. It will be out in the next quarter. Next question, Carl, is for you. I don't know if the folks in the audience know, but emerging markets are very much an institutional asset class. Almost every institutional portfolio has a significant chunk, percentage ownership in emerging markets. It has been, as you showed us, a terrible asset class to own for the last 3 or 4 years. And congratulations to you, a great call. We have not been invested, but with the values as low as you showed us, when is it time for us to start nibbling? I thought we were supposed to buy when there's blood in the streets, right?
Yeah, it hasn't gotten quite that bad yet, sorry, but might be headed in that direction. Yeah, I mean, it wasn't that long ago that emerging markets were kind of the hot asset class to be in, where the best returns were, it's where the best growth was around the world. And I think it really does start and maybe end with China, actually, and we talked a lot, or I talked a little bit about the ongoing slowdown in China. A lot of these economies kind of hitched their wagons, so to speak, to the sort of Chinese growth story that was occurring over the last 15 to 20 years, up until very recently, and increased, their trade linkages with China, sent them a lot of goods and that sort of thing. And so as China is slowing down, that's directly impacting a lot of these economies that we're exporting to China. So that's one thing. Another thing is what we were just kind of hitting on. The commodity story has really kind of flipped over the last 12 to 18 months. We've seen huge declines across a lot of commodity prices, and a lot of emerging market economies are actually big commodity producers. More so, significantly more so than most developed economies are these days. So that, again, directly impacts, these economies that are producing a lot of these commodities coming out of the ground. There are actually some pretty big emerging market economies that, again, we're doing pretty well recently, notably Brazil and even Russia, they're in very deep recessions at the moment. And it's kind of a combination of these different factors hitting at once. And then the last thing I'll just add is that, during that sort of the up cycle, when growth was really good and everything was going well, it turns out that emerging economies added a lot of debt. It wasn't, they part of their growth story was similar to other growth stories. There was a credit cycle involved, and we seem to be kind of on the other side of that mountain now. And so you're dealing with heavily indebted economies in some cases, and everything we've learned about economies with lots of debt, particularly in Europe and places like that over the last few years, those same rules sort of apply to emerging economies, where it really weighs on growth and prevents the sort of dynamic growth that they were previously experiencing. So again, I think there's a combination of those different things that they're dealing with at the moment.
Great, thank you. We have some great questions. Woo-woo! So we're going to see what we can't do to get through them.
Do you have it?
Excuse me?
Do you, Sauro?
Yeah, I know, but the one I got from the audience is the one
Okay.
that I had for Sauro anyway, so it works out really good. If somebody from Pinnacle will just, because we're going to get into this, somebody drag us off the podium when we're out of time, whenever that is. So someone will give us a head start. Let's get started. First question from the audience, Sauro, is about the quant model. Suspiciously, perhaps, we haven't been talking about our quantitative models, so maybe you could give us a little bit of an update. What's going on with dynamic quant?
Yes. So dynamic quant. So dynamic quant currently is invested defensively, consistent with what's been going on with the market. Sean has been talking about the S&P 500 being in a downtrend. The quant model also has recognized this downtrend and has moved to a defensive stance, so that's where it is right now. As far as how it has been doing, we launched the strategy in the first quarter of last year, and it's been a pretty tough year for the strategy. Keep in mind, this is a model-driven, rules-based strategy, so from that perspective, it's essentially doing exactly what we expected it to do, which is the good part. The bad part is that, unfortunately, last year has been a pretty bad environment for this type of strategy. And when we were doing the work and building the strategy, we were able to identify certain scenarios where we knew that the strategy would not perform as well. One of them was, over time, you occasionally have periods where sectors of the U.S. market that appear to be undervalued end up getting even more undervalued, and in doing so, they lose more money. Think about energy last year, that's exactly what happened. There are also some periods of time when the market is not really in a clear trend, but it's more range bound and moving in a very volatile fashion in that range. And again, that's what happened with the S&P 500 last year. So essentially, we think last year was pretty much a textbook example of the type of scenario in which this strategy doesn't perform as well. But the key thing to keep in mind is that this strategy is supposed to generate alpha and beat the benchmark over the long term. There are going to be periods of time when the environment is not as favorable. That was the case last year. We've seen that happen, plenty of times in our backtest, in our work across different markets and different time frames. It's going to happen again in the future. But the key point is that those types of environments happen the minority of the time. The majority of the time, when the strategy is in gear, we still expect it to generate alpha, beat the benchmark, and do so by enough to make up for whatever it has underperformed during those periods that were not as favorable. So at this time, we think the strategy is acting the way we expect it to act, and we still have a lot of confidence that over the long term, this is still a valid investment strategy, and that investors that can be patient and stay the course are going to be rewarded.
Thank you, Sauro. The next question is absolutely so amazing. I don't want to embarrass anyone, but if you wrote this question, I'm going to ask you to raise your hand. The question is, forecasting bear conditions, have analysts ever accurately predicted a bear market? Is that person in the room? Want to raise your hand? Okay, I owe you $20 for this question because I'm going to take the first part of this answer. This is a yes or no question. The answer is yes. These analysts forecasted accurately the last bear market in 2008, took our portfolios dramatically conservative to 50%, I think, actually, or less, right around 50% of benchmark, and it was a heroic call and a forecast, but perhaps in a broader sense, Rick, I'm going to ask you to address this just in terms of more generally, how does our process help us accurately predict bear markets? I mean, it's a very risky thing, to your point, to do it.
Yeah, it's not an easy thing to do, which is, if it was, we'd all be sitting on the beach, right? Enjoying a cold one doing it, but often investing markets is a frustrating thing to do as well. We do the best we can to look at all the things that we think matter the most to be able to assess market cycles. So you just saw them there. I mean, to have a feel for whether the economy is going up or down, right? That has a major impact, in our opinion, in terms of what's going to happen in markets. To watch what happens in the technical conditions of the market. Again, there are many different technicals you could focus on, right? And many guys are just swing trading all over the place, and to us that's just noise. We think there are certainly technical areas that we're focusing on that can help you try to identify the primary trends in the market. That doesn't mean that any one of these things, whether it be quant, technicals, business cycle, valuation, none of them as one standalone unit will ever work. That's why we look at so many different things and so many different indicators and try to weigh the evidence up. It can just give us a better probability of identifying a period where the trend will either be in a primary uptrend or downtrend, and that's the best you could do. And then you apply your common sense and some judgment to it, right? In terms of at least the primary market models, and that's the best I think anyone could do. I mean, anyone that's selling you something that they think can call everything, every market movement is just lying. You should run quickly, if you hear that stuff. So, we're kind of brutally honest here. We think we put together a very robust process that's covering all the bases and gives us the best probability to make those calls, but we're also acknowledging that you also get these things wrong sometimes. Like I said before, we can't be dogmatic in what we're doing. At some point, the markets will tell us if we're wrong. We have to watch these signals. Ultimately, we think we're watching enough things over time that we can do this and add some value to our portfolios and help the risk manage. But, I mean, there's no perfect way to do this. We just think we've done a pretty good job of building a system that gives us a leg up on the competition.
Thanks, Rick. Carl, I think I'm going to send this question out to you. It's an interesting question. It says many of your models, which I'm reading as strategies, many of your strategies, seem to resemble the S&P 500. Why would I not simply invest in an S&P 500 index fund? So since you're our analyst who's directing our international investments in the portfolio, maybe you could talk a little bit about the dynamics between that allocation of a portfolio, the S&P, and kind of dig into this a little bit.
Yeah, I can start with this. Just we think there's a lot of different ways to add alpha in the portfolio. So it starts with.
I have to interrupt you. What did you say?
Alpha trying to outperform, the benchmark.
Okay.
So it obviously, and there's different layers of that. So it definitely starts with us at the top level of how much risk do we want to be taking, which is kind of the focus of most of the comments today. But then within that, we spend a lot of time on selection. What do we want to own with what we actually, with the money that we still have invested at the time. So even within the S&P 500, we think, at times there's always, certain sectors of the market that are more attractive than others. And so we do a lot of sector rotation in portfolios. Our performance numbers over time have shown that the sector rotation has actually added, a pretty good amount of alpha over time. And then to your point also, we think there are other areas of the world that you can go to try to take advantage of. And so, we have kind of the same exercise on the international side where we're trying to evaluate different regions and countries of the world and figure out if it doesn't make sense to, or when it makes sense to, allocate to some of those areas. So again, it's kind of a multi-layered approach, and we think there are different ways that we can add alpha within that.
Can I just make just one quick add to that too, and I think some of what you saw today is exactly why you wouldn't want to just focus on the S&P 500. In other words, we saw some charts about valuation in the U.S. being very high, whereas Carl told you that we have relative value across markets. Now, we don't think the catalyst is there to unlock that value yet, but when the time comes to have the flexibility to be able to move away from the S&P and go to the undervalued markets that now have a catalyst, we think is a big advantage. This is probably the worst time to just lock yourself into an S&P-centric type mentality because it's worked for the last 5 years.
Sauro, we have a question for you. Actually, it wasn't based on your presentation, but it is based on the sector you follow. The question is, should we be worried about the banks? What's going on with stress tests nowadays? What is going on? What's happening?
So over the past few months, as we've had this correction in the S&P 500, what we've seen is that the U.S. financial sector, and specifically the banks, have gone through some rough underperformance. They have underperformed the S&P 500 by a significant amount, to the point that, some people are starting to get a little bit concerned that this might be a sign of worse things to come. From our perspective, our view is that was a lot of that was related to what's going on with interest rates. So the banks, the U.S. banks, have been for a long time have been desperately needing higher interest rates and a steeper yield curve in order to finally be able to generate higher profits. And at the beginning of last year, actually, the expectation was that that scenario was about to come to fruition. But as we saw in the second half of the year, that didn't happen. Interest rates actually started to move back down. I'm talking about longer-term interest rates, such as the 10-year Treasury yield. And that caused a re-rating of the profit outlook for the banks. Another thing that played a role is the fact that credit spreads have been widening in the U.S., and that typically tends to correlate with the underperformance of the banks. However, most of that widening of the credit spread was related to the oil industry, and actually the U.S. banks have been pretty good at disclosing how much exposure they have to the industry, and at this point the estimate is that that exposure should be fairly contained. So right now we think that the fears of potential bank failures and systemic risk, at least as far as the big U.S. banks are concerned, is pretty limited, especially because the US banks, again, have been very good at cleaning up their balance sheets since the last financial crisis. They're actually much better capitalized than they were before the financial crisis in '08. Again, we don't think, we think concerns of systemic risk at this point might be overblown. We are underweight at the moment, the US financial sector and the banks specifically, but that has more to do with our overall outlook with the market. The sector and the banks overall tend to have a pretty high beta to the overall market, so when the market goes down, those companies tend to underperform. Also, even though we may not be too concerned about systemic risk, we still have a lot of questions about the profitability of these banks. It continues to be a very challenging environment as interest rates remain very low. We're seeing increased regulation for the banks. So a lot of questions as to whether they're going to finally be able to deliver higher profits.
Thanks, Sauro.
Really quick on that.
Wait a minute, the question was about Italian banks. No, it wasn't. Go ahead.
I just want to add, if you look at bubbles that are formed around markets, typically you have a very long repair period. And going back to 2000, we've had a couple bubbles that have formed. First it was tech, then it was home builders and financial stocks in '08, and now the commodity bubble is bursting. And if you look at price patterns based on these bubbles bursting, they tend to remain relatively flat for long periods of time relative to the S&P 500. So if you look at the tech market back in 2000, it remained relatively flat until roughly 2007, 2008, and now it's starting to outperform. Same with financials. We think that they're in this repair phase. Eventually they're going to be in a good spot again, but until they're done this repair phase, we think more work is needed on the technical side, and that's what energy is going through right now. So that's going to be sort of the dominant theme for energy going forward as well.
All right, great. I'm being told we have time for 2 more questions. So, Carl, this one's for you.
Okay.
And it's, I think, a really good one. It's asking any parallels between Japan's continued stagnation and our current situation here in the U.S.
On some levels, it might seem that way, just in terms of the trajectory of where rates have gone to and that sort of thing. I mean, Japan has had little to no growth now for 25 years. I think it was 1989, 1990 when their cycle kind of ended. And interest rates over there have been at 0 for a very long time, the official central bank rate. And so, on some levels, I think people are starting to draw that comparison because of that. But I think most people would argue that it's not the same thing. There are some pretty fundamental differences between just structural differences in the economies, between a very dynamic, although developed economy like the U.S. is still very dynamic. We have a lot of innovation. Certain parts of certain industries and parts of the economy are under pressure at the moment, but other parts of the economy are doing really well still. A very vibrant technology and healthcare sector and that sort of thing. Over in Japan, they have some pretty significant challenges from a demographic perspective. They have a very rapidly aging society. They allow virtually no immigration. So there are some pretty big structural things that are weighing against Japan that are just very different than the way that the U.S. Economy is set up. So.
Okay, and finally, I had asked our audience to stump the panel. And yes?
No, if you said audience, well, what is it? And actually, the immigration has slowed down in the U.S. as well. And, speaking of the, Japanese not having more people, I mean, you have the technological innovation and automation that I think I read something that they're going to be supplementing on that end. So what do you...
In Japan specifically?
Well, all over, in the U.S., Europe, Japan, and all the other areas as well. I mean, especially with the what has happened with fracking, the new technology moving there in medicine as well, the healthcare sector also. I mean, in just about all areas.
Yeah.
The technology's been.
I think the larger point there might be that technology is pretty exciting, and I think it continues to kind of push everything forward, but at the same time, to your point, it's very disruptive in a lot of cases. So when you automate factories, all of a sudden you don't need quite as many workers to do the normal tasks that they were doing previously. So there are these disruptions that are occurring, you're right, but I think at the same time, and again, I would say sort of the US more so than a country like Japan, there is still a lot of innovation going on in other places that will allow growth to continue to move forward, even though in some cases it's going to be very disruptive.
Thanks, Carl. All right, one last question, folks. Thank you for your patience. We're going to do this last one, as I was saying before. This is the doozy, and so I'm giving it to Rick, which is with zero or negative interest rates, lack of certainty in the bond market, and a volatile stock market, are there any safer bets in secure income for retirement? I'm dying to hear this.
Thank you, Janet Yellen. This is where we get angry. We love those stock markets when they go up, but there's nothing to invest safely at the bottom of the spectrum. It's something we've been hearing about from people for years. I mean, there's certain things out there. I mean, municipal bonds right now don't look terrible in relation to what's going on. But frankly, I mean, this is part of the problem that Carl was talking about. You're bumping into a period here where, there's been so much unusual monetary support, again, to try to stimulate asset prices, get people encouraged, foster animal spirits, and hopefully the entire business cycle picks up, gets stronger, and it all feeds on itself. Right? That all sounds great, and asset prices went up for a long time, but what happens to the saver? The saver's been hurt. I mean, there's no two ways about it. At the moment, we're going to buy a T-bill for 30 basis points, a CD that might be marginally better than that. I mean, CDs aren't horrific in relation to what you can get at the very short end of the curve, but there's not a whole lot of safety that gives you any yield in a world where the central banks have decided to take things to zero and now even negative. That's just the world we live in. It gets tougher and tougher. And what they're trying to do is they're trying to encourage us to go out the risk spectrum, right? Get out there and get going, and hopefully it will feed on itself. But in the meantime, it makes it a very challenging environment. I mean, in fixed income, there are places to get yield, right? I mean, high yield right now has a great yield on it. The only problem is that yield might get even better, right? And the price, you might lose a lot of money in the process. So safety and yield at the moment are almost an oxymoron, I think. They really don't exist at the bottom of the level. Maybe if we get a few more interest rate increases from Janet Yellen, if the economy can handle it, that will begin to normalize things like they'd like to see, and you'll start to see some short-term fixed income products with decent-sized yields. But until then, yeah, I mean, maybe short-term municipal bonds, like I said, out there, very short-term corporates. Give you a little bit of spread and maybe a lot more safety than their high yield, counterparts. But it is a very big challenge for us right now to find, high, decent yielding products that have any kind of safety, because they're just really not available due to what the central banks are sort of handing us. So we're doing the best we can in kind of a very unusual environment. But just this is the way I would look at it. I mean, anything you're really getting a yield on is not going to be that safe right here.
Thank you, Rick. I would just add to that those of you who have questions about retirement income, where are the best places to draw income from your portfolio, what strategies do we use at Pinnacle to fund retirement, you're going to find that those are pretty much total return strategies from our portfolios, and your wealth managers are be more than happy to sit down and go over the details of that with you.